Good evening, everyone. I hope all of you are safe and well in your homes or wherever you are, given the time. Now, I know we've been spending about a year and a half almost of very challenging times with COVID. I'd like to sort of pose the question to everybody to say, who really feels like going on a vacation right now? I don't know about you, but I would really love one. But imagine yourself on a beach like this. Yeah, I think all of us do. But you'd like to imagine yourself on a beach like this if you really wanted a vacation. Let's look at that beach that we're going to head towards. Yeah, depressing, wouldn't it? This was actually a reality for me a couple of years ago when I took a short trip to Bali. And not was it only a disappointing vacation for me, I realized that the social implications of this and the economic implications on the islanders were massive. There were health issues, their businesses were collapsing. But unfortunately for Bali, this was not something that they could control. It was the neighboring islanders and their waste management that was impacting them. They'll be cleaning their beaches morning and evening, but nothing they could do about it. In reality, this is the same thing in our journey towards progressing towards a better planet. And that is why ACCA has brought us here today. I am Pumi Samanasekara. I'm a principal/partner at KPMG Sri Lanka in charge of sustainability, family business, and board governance. I'll be a speaker and the moderator for today's panel. I also have with me my colleague Manpreet Singh, who is a partner for climate change, sustainability, CSR services, and a global leader, and green and social bonds. He is from our Indian practice, who will be a speaker and a panelist. We also have a very interesting line of panelists who are at the forefront of this ESG journey and who are very experienced. So please line up your questions. We have Azam Bakir Marker, who is Partnerships and Development Finance Specialist at United Nations Resident Coordinator's Office in Sri Lanka. Azam, if you could put your video on for the benefit of the audience. We have Jasmine Lim, who is the Head of Sustainable Finance, Regional Client Coverage, Commercial Banking, Asia Pacific at HSBC. We have Arif Mirza, Head of Policy, MISA SCCA. And definitely last, but not definitely least, Vishal Bazwa, Head of Corporate Sustainability, Ultratech Cement, who will bring in their practical experiences for us. Today's lineup really is a very, very short presentation by myself and Manpreet on just the thematic things on why ESG and how, and then we dive directly into an hour of a panel discussion. Looking at the evolution of ESG, all of you would really remember that it was more corporate social responsibility, where we do a few things to make ourselves feel good about it maybe, or to look good. And then of course the ESG wave came about, which is ESG 1.0 as we call it, which required better business reporting, which all of us are doing right now. But now it's progressed into ESG wave 2.0. Now this is due to various pressures that are coming and also various opportunities. Just let's very quickly look at what these pressures are and how the world is changing. See, long time ago when we spoke about climate change, when I was growing up, for instance, it was about the ozone layer, or it was about the ice melting somewhere in a far away place, almost imaginary, unless you live close to it, or it was impacting you. But now the reality is that climate change is at your doorstep. It's impacting our lives. Looking at it from closer to home, we've had our floods. I mean, in Chennai, in India, in Sri Lanka, maybe Bangladesh. But looking at even some of the wildfires world over, which has resulted in companies going into bankruptcy. For example, PG&E in California, which is an energy company, filed for bankruptcy after the wildfires. Insurance companies are seeing massive losses. These existential threats are now impacting our day-to-day. Looking at it from social element, now this is environmental, social element of things. Society is changing. I would say tolerance is changing. There was a product, if you do remember, some of you would, is Fair and Lovely from Unilever, which was to say that if you were fair, you were lovely. But then looking at us, I would say people of darker skin color, would that mean that if you're not fair, that you were ugly? So this is what people were looking at and thinking, which was leading to reputational issues as well as top line issues in losing customers. There's increasing regulatory pressure with data privacy issues that are coming. I mean, Facebook faced this. There's diversity laws coming in to be more inclusive in the boardroom, for example, and you can see this happening in California. On top of that, long time ago, reduction in costs, being competitive, meant sometimes unethical practices. There were times when cost reductions involved child labor, slave labor, but now that has been resulting in reputational issues. But now you could see that this can be also turned into an opportunity where instead of actually going on a cost reduction, companies and garment industries in Sri Lanka, for instance, use this to an advantage and said, branded themselves as garments without guilt. They eliminated unethical practices and targeted customers who would want to have a competitive advantage through having ethical supply chains. And this really helped us. You could see this even more in recent examples. There were factories and companies who were looking after their employees' welfare through vaccinations, through welfare, through rations, taking care of their families when they were ill during COVID, where their trade unions are running operations and ensuring continuity when things are becoming dire, which is right now in Sri Lanka, whereas the others are finding it difficult to even continue operations. Another aspect of this is to really look at the practical side of things, right? So whenever we talk of the risks and the opportunities, there's always somewhat of the naysayers, or I would say even a myth, where you say, okay, I mean, great, ESG has all of this, but it comes at an expense to investment performance. Can we really afford it? But I'd really like to debunk this myth, because there's more than even 2,000 academic studies, over 70% of which really says that there is a positive correlation between ESG initiatives being in business and business performance. And this you can see even in indices closer to Sri Lanka. I mean, the statistics on your screen right now is about MSI India ESG Leader Stats, which is way above the usual MSI index for all India. So this you can see even closer to home. But do we really have investors investing? That's the next question. They talk about it, but they don't invest. But what you can see really is the investors who are investing in ESG related matters are increasing year on year, which is comforting. And we have Jasmine as a panelist who's going to speak more about this. But the question really is it really growing fast enough for us to make the planet a better place, to put it shortly? While there is a question of speed, I think we need to appreciate that there are examples of those who walk the talk. There's regulatory changes that are coming up in the UK on establishing guidelines on climate risk reporting, in measuring the climate risk impact on the financial system. We have investors like BlackRock who are moving away from thermal coal production investments. They're asking to disclose climate-related risks if you're a company or a subsidiary. They're voting against management on the lack of progress on climate concerns. They're directing companies to have more faster climate action. There's, in fact, they withheld the support for the re-election of the board. There's more governments who are actioning. Canada, France, who are looking at more climate disclosures. We have Japan, who has embraced TCFD. And of course, civil action. There's a lot of individuals, like a student in Melbourne who sued the government on environmental and climate-related issues. So there is a lot of stakeholder activism. There is increasing pressure, regulatory, there's market value and share price related correlations, and of course, there is that existential threat at our doorstep. So this is creating this new wave. But let's talk about the G a little bit. And I think this is again for the panel later on. There's been examples of where we tick the box, but we didn't quite meet the requirement. I mean, Volkswagen had the diesel scandal where they failed to disclose or even failed to put in the right parts, the mechanical parts, just to, pass an emission test. And then their CEO at the time, Mr. Winterkern, had no way. He had to resign because there was a blatant disregard in terms of the governance aspect of it. So there is a way for it to be exposed if you don't worry about the G as well. Right, so moving on from this point, I would like to sort of engage our audience. We have almost 100 participants online, to take a poll and just tell us about your industry, who's responsible, and then where you are in your organization. So the first question is, what industry is your organization from? Let's see what sort of audience we have today. Okay. So we have a lot of banking and finance, manufacturing and other, and a little bit of power and energy. Great. Okay. Who is responsible for sustainability in your organization? At least, how do you see it? Let's look at the practical aspect of it, not what's on paper. Yep, we have a separate team, no one yet. Few have a head of sustainability. Okay, there's a very small percentage that says it's the board. Okay, great. Let's look at the next question. Which stage of the ESG journey are you in? Just starting out, we've integrated ESG to business strategy. That's great. We have some ESG initiatives we report and disclose. Okay, right. And what changes have you seen in your region? As we may have individuals joining from different regions in South Asia. Yeah, regulations and fines, customer demands, that's great, and investors demanding. Yeah, we've seen a lot of that as well. Great. So thanks, Kailesh. And we need to now maybe just very quickly take you through a very introductory video for the benefit of those who are maybe not involved on the ESG journey of the stakeholders and where we need to be headed.
The world has changed, and it's not just because of COVID. Consumers and employees have increasingly different expectations of the world and the businesses they buy from and work for. Your shareholders and lenders are under pressure from regulators and the market to prove that they're acting responsibly and investing sustainably. All will be making choices about which organisations they work with. So will yours be one of them? Each stakeholder looks at your business through their own lens, and this is your opportunity to choose what's behind it. What is your impact on our planet? What do you contribute to the communities you operate in? And how do you conduct yourself? ESG isn't something you do, it's everything you do, and how you do it. It's your licence to operate, and it's your opportunity to lead. Your ESG strategy must be authentic, embedded in your business strategy, and owned by your board. Your ESG narrative looks right across your business and tells that story to the world. And your ESG metrics help people compare you with others, often via a rating. You'll want to consider how you conduct yourself as an organisation and look to the ethics throughout your supply chain. What part do you play in the community? Is your business inclusive? Are you well governed? And is your leadership diverse and set up to hold the business to account? Look at the impacts of climate change, at the natural resources you consume and the waste you produce. Do you pay fair taxes? Treat your customers and suppliers ethically? And do your employees have safe, fair working conditions, and could they speak out if they see something wrong? Understand where you're strong and can be proud. And know where you're vulnerable and then have a plan to make it better. People will expect you to set clear targets and have the data to measure your progress and report it to the world. They'll want the assurance that what's behind the curtain supports your performance and won't let you down. Your metrics will encourage investment and your narrative will talk to your stakeholders. When you're done, you'll have a resilient business set to thrive in the new reality. And you'll be playing your part to make the world a more sustainable, fairer and better place for everyone. It's the right thing to do.
So that's a summary of where we're headed. And I think we just looked at the why and the pressures that's supporting the ESG. Now I think it's time to start looking at the how. What we're going to do in this segment very quickly is take you through some short examples, take you through some analogies, which Manpreet is actually going to do as well. And then bring out some thoughts in you and inspire you a little bit, because the how takes a long time to take you through in terms of how it is to be done. So starting off, I mean, I just want to break one of those another myths that come up. Adopting ESG is only an internal adoption, like we're all trying to integrate it into the business model. That's one, and that is a great thing to do. But there's also other ways that you could start off maybe, and that's to look at restriction screening, which is maybe negative screening. Take out certain sectors and issues that you would not want to invest in. Maybe look at thematic investments, where you would look at investments towards sectors to solve certain sustainability related challenges. Or it could be impact investing. I mean, I know we have a few impact investors in the country as well, who's looking specifically at delivering a specific and measurable set of positive social or environmental impacts. So these are other ways that you can do this. But if you look at business integration, there's different aspects that you need to go through. You have to go down to the fundamentals and break down your business model when it comes to the core of it. But there's strategy you have to look at, there's risk management you have to look at, supply chain, circular economy, reporting. We're not going to touch on all of this. We're going to touch maybe on risk, circular economy, and reporting massively. And then Manpreet will sort of build the rest of it into his examples. So looking at risk management, I just want to touch on the fact that how the risk management landscape has really changed. And this is something that boardrooms need to take a conscious effort to incorporate into their discussions. Long time ago, when we sit at board meetings, we're talking about asset price collapses and oil price spikes that are impacting our businesses. Natural disasters were maybe okay in terms of impact, quite high, but the likelihood was always taken as quite low. But you can see how from 2010 to 2020, likelihood and impact has really changed. You have extreme weather, climate action failure, natural disasters, biodiversity loss, all in the top tier of impact and likelihood, which is why climate risk has become a hot topic, and breaking down climate risk is important, and understanding this is very important. So just a brief introduction. It's physical risks. That is one aspect. There's transition risk. Physical risks are actual losses to physical things, like a wildfire could, destroy your factory, or a flood could just destroy your operations. But there's also transitional risks, which is basically what it takes to transition into a low carbon economy. You have technological changes that are going to come about in this. You'll have policy changes that is going to impact your business, and you will have to incorporate. Of course, there's going to be reputational issues, and then the customers and the market that changes with it. See, the impact of it can be broken down in so many different ways. You might have to think about emergency response costs, contingency planning based on your supply chain. You will have to look at climate change litigation, humanitarian loss, which maybe you've experienced already recently, all of which is going to impact your bottom line as well. So some of this is going to get captured under reporting, under TCFD, and Manpreet's going to speak about that a little while later in a bit more detail, so that you can take home some learning points from it as well. The how also then breaks down into a few other things, which is strategy, risk, supply chain, circular economy, and reporting. But we have to look at it in 3 simple steps, and Manpreet's going to start from here and take you through the nitty-gritties. Manpreet, over to you.
Thank you, Pimi, for setting the excellent context to this, and I think it couldn't have been done much better than this. So thank you for doing that, and very good afternoon to all of you. Thank you for joining this session. I think we are really excited to see a lot of diversified sectors that are represented today in this presentation. I think I will try to make it relevant in general for all sectors, so that I'm not particularly focusing on a few, but I'm sure there are case studies that we have today which may be applicable to specific sectors. So when we talk about business integration of ESG, I think definitely the first step is to get the basics right, which means first of all, trying to understand where you are in terms of what you do on ESG. A lot of times what we've seen with our clients is, while they are doing a number of scattered things within ESG, but they're not structured in a way that they're able to understand what they really do and what their actual ESG performance is. And therefore, it is essential that at every step in time, we are able to first of all define what we are intending to do, and therefore have a very clear ESG vision, which is usually and ideally driven by the top management, where there is utmost clarity on what you need to do and what you're intending to do with ESG, which clearly means that are we looking at integrating ESG into the entire business operations? Are we able to prioritize what sort of material issues are impacting our business and going to be relevant in the future? And what are the ways in which we are going to ensure that we are able to take up ambitions, goals, and targets which are going to get validated? So how do we ensure that we are clear about where we are, and how do we ensure that we are able to identify very clearly the kind of gaps that we have today on ESG, especially after doing a very detailed materiality assessment to identify the sector-specific issues, the issues specific to certain stakeholders and shareholders, which are going to have a material impact going forward. If you can move ahead to the next slide, please. And I think a very clear example, which we wanted to bring in here is one of a construction industry. One of our clients, which is a subsidiary of a large cement group, based in Switzerland, which wanted to establish, its leadership position within the group. So the group has a number of operations scattered across the globe, and the Indian operations in particular wanted to showcase leadership, by way of one, very clearly taking the paths towards quantifying the actual value generation from environment and social impacts that the company has been doing. They adopted the true value approach, and this is proprietary approach developed by KPMG to assess environment and social impacts in quantified, measurable, money terms. And what that did was to very clearly outline to the company which were the clear areas, where, the EBITDA of the company was getting eroded, and at the same time, which were the areas within ESG which were actually contributing, to a positive valuation of EBITDA. And going on from that journey, the company got listed in DJSI. It was in the top 30, when it joined DJSI. But I think in the last 3 to 4 years of their journey, it has risen to top 4 position, and has a very significant score, among the peers, globally. And what we could also, through a period of time observe was a clear cost reduction, alongside, the ESG performance benefits that, they were able to gather from there. Um, Moving on from, actually identifying the levers and be able to understand the baseline, I think the next part is to actually strengthen the core, whereby, after you've identified what the gaps are, how do you strengthen, the governance within the company on who takes, what kind of different roles, who approves projects and programs, who is ultimately responsible? Is it the executive? Is it the CEO? And how do you make measurable targets against, for example, executive compensation dependent on the ESG performance of the company? And therefore, there is a clear outline of how, different ESG issues are discussed by the board of the company as well. And there are very clear roles and responsibilities across business. The second way is to look at the risk management within the company as well, to be able to see what are the risks that the company could face from ESG issues, and thereafter develop a strategy to overcome those risks, as well as identify opportunities which will help them into strategically positioning them in the sector, and measure the progress by establishing key performance indicators and setting goals and targets which are ambitious enough, that they are in accordance with some of the trends in the sector, as well as the geography and globally as well. The examples that we wanted to bring in here is of an aluminium company, which is today a leader globally, on DJSI again. And I think the way they started was to look at improvement in their initial ESG practices while they were reporting and disclosing their material ESG issues for quite some time. I think what they decided was to very clearly get into ascertaining what are the different ways in which they are doing disclosure today, what are the ways in which they need to prioritize some of the ESG focus areas and work towards making sure that they are developing projects and programs to further increase their performance. They introduce a number of ground level interventions, as well as they looked at different criteria of rating agencies to understand how they could potentially ensure that their evaluation in terms of ESG is going to be at par with any global company that they could be benchmarked with, or any rating criteria that exists today. And therefore, the company achieved the first rank globally in DJSI, as I said, and they were able to also see incremental change in the share prices because of becoming a leader globally, and the visibility that it could get into the global space to the investors who were looking at this sector, especially with the opportunity of recycling, etc., that comes in with the sector. I think there are other issues that we did allude to, including looking at supply chain and circular economy. But let me first go towards disclosure side and reporting, because that's one of the main areas where the companies lack. They're not very clear on what are the aspects that they need to disclose. And more importantly, there are a number of standards which are available today. So there is a huge confusion in terms of what is the most relevant standard, what is the most appropriate way that they could achieve not just a higher rating but an investor preference going forward in the future. So what you look at today as investor expectations is that you should be doing everything that is available there, and I think which is where the companies are looking towards a more harmonized frameworks which captures most of the important parts of every framework that is available today. So be it the global reporting initiatives, GRI standard, which has been, I think, the most adopted internationally because of the way it has evolved through many years as being one of the pioneers in setting this up. There are increasingly uptake from an integrated reporting perspective on integration of sustainability performance with financial performance, which is where International Integrated Reporting Council has developed its guidelines, which has recently been merged, as a value reporting foundation with SASB, which is a US-based not-for-profit, which came out with, sustainability accounting standards, which outlines the material issues associated with different sectors. On the carbon and climate side, again, there has been a carbon disclosure project, which has been a voluntary standard adopted by various companies to outline specifically their performance towards carbon mitigation side and the goals and targets that they've done. TCFD has been a recent update. I think that's where the focus shifted more towards how you're contributing to global warming, to how you're going to be affected by various kinds of climate impacts that are going to be applicable to you in the future. So TCFD is a framework which basically outlines how you should be able to identify and disclose the different kinds of climate related risks that are going to impact you in the future, and you should be able to disclose those risks in financial implication terms. Recently, another exercise was undertaken by World Economic Forum, again with the whole rationale of trying to create a harmonized framework. All big fours were engaged, and it came out with a set of indicators which we all agreed are most aligned to all the different frameworks that existed today, and are also most material if a company wants to and decides to disclose on their ESG performance. I just talked about TCFD. I think the framework outlines the way in which investors today are expecting you to disclose your climate-related information. It's a strategic assessment tool. It's not just a disclosure, and that's what I would like to clarify, because it is helping you into strategically identifying the ways in which different kinds of climate risks are going to impact your organization in the future. And since we are talking about financial implications, these risks entail different aspects of affecting your profits, affecting your revenues, affecting the valuation of the assets, and so on and so forth. So I think TCFD recommends, therefore, to conduct a scenario analysis to understand how various aspects of these risks under different scenarios are going to impact your company, and how that can be defined in financial implication terms. Of course, TCFD expects you to report, on your governance, strategy, risk management, and matrices and targets as well. So I think there are various ways, which I just alluded to, into how climate risk and at large even ESG risks can impact different aspects of financial statements, be it assets or liabilities, capital and financing, and even disclosures. There are questions that are being asked today from organizations. For example, have you made a net zero commitment? Do you understand the pathways for you to become carbon neutral and net zero in the future? Do you have certain kinds of polluting assets which are going to become liabilities in the future? Are you exposed to current regulations, for example, in your geography from a carbon pricing perspective? And there are other implications from a product side as well, on whether you understand how much emissions are happening because of the manufacturing of a particular quantity of a product that you are manufacturing today, especially from the perspective that there are regulations like in the EU which are going to impact any import of goods from different countries to the EU, where you need to mandatorily disclose the carbon emissions, the and not just disclose there is going to be a tax, based on the amount of carbon emitted in developing or manufacturing of that product. And similarly, there are other questions around, whether you're looking at carbon credits or carbon offsetting, to contribute to your carbon neutrality goals in the future or not. So move ahead, please. Circular economy is again a very interesting concept where the whole world is looking at changing from linear pathways to circular pathways. There are obviously countries and within the countries companies which have established pathways to ensure that one, they're able to reduce the waste that they produce, secondly be able to reuse the waste in either their own operations or identify other industries who could potentially utilize some of the waste materials that they are generating, create some sort of partnerships together to establish business models which are closing the loop today and are also creating value in the entire value chain of a particular material which is being stopped from going towards ultimate disposal in landfills and creating a problem from a management of that kind of a waste perspective. I think all that is also leading towards environmental footprint reduction, and we've seen carbon footprint also substantially getting reduced, by way of adopting a number of circular business models that are quite specific to your operations and would need to be therefore evolved based on the products that you use and the waste that you generate out of the manufacturing processes. I think there is a example here where we're looking at a beer industry where there are specific cases in which certain measures have resulted into significant savings when it comes to water consumption, when it comes to reusing some of the waste grains that were earlier being disposed of, recovering the packaging materials and containers that were being used for ultimate sale, and also looking at different other models by which the waste is being utilized to create some other products, like waste bread, for example, in Belgian bakeries being made through the particular flour that is being utilized here. So how do we fund our ESG initiatives? And I'll not spend a lot of time here, but I think there are today a number of green financing instruments which can help you in terms of looking at financing models and financing markets. So especially green bonds are where a number of your initiatives towards enhancing your ESG performance, especially from a carbon mitigation side, could potentially be eligible under green bonds. These days we are also seeing social sustainability, ESG linked or sustainability linked bonds as well, which could be probably helpful if you have a very clear outlined KPIs which you can potentially achieve going forward in the future and are requiring funds from various investors to specifically improve your ESG performance. There are specific ESG mutual funds which are coming up these days as well for from an investment perspective. There are exchange traded funds being established as well. And we are also seeing the advent of sustainability or ESG linked loans, which are being offered in the market today. And I think Pumi already spoke to you about how ESG indices have performed probably much better than the normal companies in the index. So moving on to what's ahead for ESG, I think there are various perspectives, there are various questions, there are various there are various issues applicable to each of the different stakeholders within a company, be it the chief sustainability officer to CEO to the entire C-suite, on various ESG related issues that they need to take into account, however have some sort of a common language that they all understand, and also be able to drive sort of a positive and inclusive stakeholder engagement within as well as outside the company. and obviously have a more transparent way of disclosing their ESG performance going forward in the future. So I think it is therefore becoming very important for each stakeholder to identify where and how they can contribute towards an organization's ESG performance. And the larger motivation, therefore, is to maximize the positive impact creation of the company, as well as establish itself as a ESG conscious and a sustainable brand going forward in the future. So Pubi, I think that's where I will give it back to you. I think now I'm a panelist as well, so I hope you will not ask me very difficult questions. Probably, since we are from the same organization, I expect that you will ask me some simpler questions. Over to you.
Thanks, Manpreet. I think you pick on your own most, so I think you should brace yourself a bit. Great. So let's just line ourselves up for the panel. Can I have all our panelists on video, please? And I expect the audience to send us some interesting questions, and you can start putting it up on the questions box that's there, and it'll get directed to us. While we wait for questions from the audience, I'll get things started. I think we're missing Azam. Azam, are you on video? Great, thank you. Right, so let's start off with Arif. Arif, I know this is an ACCA event and you're the head of policy for ACCA. It's good to just hear from you first of ACCA's role as an accounting body in this journey to net zero, and how you help organizations as well as on your own.
Yeah, thanks, Pumi. I think a lot of what's already been said, but it's important to understand that for many years now, ever since businesses came into being, that the classical model of businesses is they produce something, they make a good or a service, and they sell that product or that service to customers, and in return they generate profits, they pay out dividends, and it impacts share value. So that's been the orthodox model of businesses, what Professor Mervyn King calls the take, make, and waste model of businesses. We take resources from the planet Earth, we make products or services out of them, and finally, if we look at the life cycle of products and services, we end up by wasting them. And you showed in the slide of the beach, the very end of a product life cycle ends up on somebody's beach. So, but now, apart from the profit dimension, there are three other dimensions now that businesses will have to, manage: the environmental dimension, the social dimension, and the governance dimension. So, whereas we were only concerned about, the financial footprint of a product, i.e., how much profit are we making, what is the dividends we can pay our share owners, and what is the value of shares, I think now the footprint has to be, well, what's our carbon footprint of a product? What's the water footprint of a product? What's the racial footprint of a product? What's the human rights footprint of a product? What is the pay equality footprint of a product? All sorts of footprints that we are now looking at in terms of, trying to sort of, if you like, value a company. Yeah, and it's that sort of dilemma now that managers and leaders are faced with, that they are no longer able to concentrate on one dimension. To run an effective business and to manage the risks surrounding businesses, you have to focus on these three dimensions, of environmental, social, and governance. And those dimensions create risks. And like you've mentioned, those are physical risks, they are transition risks, but they're also reputational risks as well now that many organizations face. And unless you manage your risks, you're going to lose your customers, you're going to lose your employees, you're going to be fined heavily, and eventually you're going to lose your shareholder value. So I think, these are very important facts that businesses have to deal with. And and there is going to be additional cost coming onto your balance sheet as a result of managing ESG. Yeah, the pictures that you showed of plastic bottles, no doubt they're coming from companies, like the soft drinks vendors, like water vendors, the big multinationals. But those multinationals are certainly not accounting for the cost of cleaning those beaches. Yeah, and clearly there's a demand, a global demand through the COP mechanism that companies now have to account for and report on the life cycle of their products and services. So I'll just stop there and let the discussion go a bit further. But I think, we need to ring fence the discussion because it's huge. Yeah, there's so much to talk about.
Of course, there is so much. So I'd just like to refocus and then sort of pose it to Azam from the UN. I mean, there are SDGs that are out there, and there's material aspects that we're discussing. There's so many different initiatives that companies can take ahead. So which should we be focusing on? I mean, there's so many of them. Can we do it all? What are your thoughts?
Thanks, Kimi. I mean, Arif made an excellent intervention, and I am impatient to sort of take something from it before I answer your question. I mean, Arif made an excellent point. The pandemic itself has presented a unique opportunity to examine the relationship between ESG and business performance in a time of crisis. And one of the strongest points came in the form of ESG fund performance data. And the recent data shows that ESG funds have consistently outperformed since COVID-19 landed. I'm sure our friends in the panel could touch on this, and the fact that Arif spoke about so many footprints, right? And when it coming from an accountant, one may wonder, hang on, there's account himself are trying to bring in more lines to report on, good for business, right? So, I mean, the point is, it's bigger than that at the moment, isn't it? So when we started the sustainability journey, businesses were looking at what is their environmental footprint, social footprint, what good could they do in community. But going forward, now business is asking, what is the purpose of the business? Right? Why are businesses there? How can we make sure that we grow in the long term? And how can we make a value, generate value in the long term? And if you look at the 2030 agenda, it provides a shared global framework for global sustainable development. The SDGs presents an ambitious and inclusive vision and aspires for a world free from poverty, hunger, discrimination, and peaceful, and a healthy planet. And the growing global capitalism has relatively weakened the power of states and multinational institutions, which has increased in importance, and global businesses are engaging in sustainable development. Right? So the global business has had a greater responsibility now to really take on some of the challenges. And there's some fascinating points. If you look at the Edelman, this spring's insights, it talks about how it surveyed 28 countries, 33,000 people, and it finds, believe it or not, business is the most trusted entity at the moment. Given the pandemic, certain governments' response has collapsed, and they expect their employers to deliver. They expect businesses to deliver. It really puts a lot of pressure on the business right now as to how can they really take up this expectation, right? And they need to work with the governments. They need to work with the community to make sure these expectations from the public is well addressed. So we're really living in sort of extraordinary times, really. So the whole ESG journey we've seen, we thought as practitioners, and we've been in this for about 15 years or so, we see initially the business case wasn't very clear to convince. I used to develop a sustainability strategy for a diversified business, and I told this to people. I used to go around with several sectors, companies, and establish environmental management systems and so on, and they keep asking me, Azam, what's up? Nobody's asking for this. None of our customers are asking for this. Why are you trying to force this down our throat, so to say? And we said, look, customers will ask. Give 2 years, they'll start asking. And same thing happened. You see, customers are having pages and pages of questionnaires, financial markets are asking questions from businesses, and so on. And now it has become that businesses are expected as an entity in the whole of society to play their role, not just the business. So no longer Mervyn King's point matters, isn't it, Arif? So it's a broader role now, and public is asking that question. What SDGs provide, I mean, to answer your question very briefly, is that it provides that platform for a framework for businesses to understand what is humanity's long-term growth area, or what is it trying to achieve, and if you look at it gives clarity and direction. And there are 3 distinct ways which SDGs can prove beneficial in this sphere. Firstly, as a universally aligned and agreed upon delimited set of challenges, they define the potential sustainable development issues that businesses might be engaging with, might need to engage. Second, a common set of goals around which multiple sets of stakeholders may assemble for. So you have the indicators, the targets, and the goals, right? And thirdly, SDGs appreciate the integrated and systemic nature of sustainable development issues. So you could see how health impacts social, how it impacts environment, impacts people, and so on. So the interconnectedness, interdependency. So businesses are able to understand the broader challenges better through the SDGs. The UN itself has several opportunities for the businesses to engage in the sustainable development agenda. You have the UN Global Compact, which is the world's largest corporate citizenship initiative, based on 10 principles of environment, labor, anti-corruption, and human rights. It engages tens of thousands of businesses across the globe on supporting the goals. It has many frameworks and supports initiatives of businesses who want to get into this journey. And the GRI, which Manpreet referred to, the Global Compact, and the World Business Council for Sustainable Development has jointly developed a tool called SDG Compass. And that's something that I would encourage businesses to look at. It's a guide for business action on the SDGs and designed to assist companies in maximizing their contribution towards the sustainable development goals. And it lists 5 steps. So 1, understanding the business case, defining priorities, setting goals, integrating, reporting, and communicating. So it covers the whole chain, so to say. So that's something that I would ask our attendees also to look at, is the SDG as well. I'll leave it there. I mean, there are plenty of other opportunities as well. Over to you.
Thanks, Azam. I think that's a brilliant point that you brought along with what Arif brought in. I know the accountants are bringing in more line items, but I think it's very important that we quantify them. In those lines, I mean, we have Vishal, who is from Ultratech, and he's been there, done that. He has a brilliant history of experience in actually getting his hands dirty. Vishal, couple of things. I'll frame this differently because there's a lot that you can really say. How did you, or how did the organizations that you were involved in, how did they take this journey forward? I mean, is it just a reporting exercise? I know there's been a lot of business integration. You know, how did you decide what to choose? And how was this journey? What were the first steps, and how did you manage to go through it? I know there's a lot that you have to say, but if you can keep it concise, and then we can start digging a little deeper as well.
All right. Thanks, Bhumi. So just I'll introduce my company. I am from Ultratech Cement, and it's the largest cement manufacturer in India. And it is the 3rd largest manufacturer of cement, concrete, and RMC, operating out of India predominantly, but we also operate in Middle East and Sri Lanka. In terms of ESG and sustainability, our journey started way back in 2004. We were the early starter, and the management had a belief that as an organization, we would want to create value for various stakeholders. So initially, all of it started with adoption of frameworks, and like all our organization, we started with adopting our framework to, or aligning our framework to GRI. But gradually, when we moved on, we tried benchmarking ourselves to global companies in terms of our sector or beyond our sector. we looked at what kind of policies they have from ESG and sustainability. So couple of examples on policy front, if I give, initially maybe we didn't have focused policies on, let's say, energy and carbon or biodiversity, or let's say discrimination or anti-corruption and bribery. All of those policies earlier were there as part of an overarching policy in our case. But as we moved on, we felt that there is a need to come up with new policies, specific policies to address these issues. And that's how we started our journey in terms of looking at new policies. Ultratech also is part of a large group. We are a part of conglomerate. We are part of Aditya Birla Group. And as ABG, we have a framework on sustainability.
Vishal, you're breaking
which again, am I audible? Yeah. So I was saying that as ABG, we have a strategy, overall strategy on sustainability, which again is benchmarked to global standards of, let's say, IFC performance standard, various other international standards. So as a ABG company, again, we had aligned ourselves to the ESG and sustainability standards globally. And in our journey, actually, we have adopted new concepts like internal carbon price. We have also adopted 2 TCFD disclosure just now. Actually, the last financial year, we also disclosed to our TCFD, our climate disclosure aligned to TCFD. We also have committed to science-based target. We have got our targets validated. So we have adopted new policies. We have benchmarked and looked at new policies, processes, and standards aligned to the global requirements, and that's how it went all for us, Yumi.
That's great. Vishal, just a question on maybe the governance side of things. I know there's a lot that you have done from policies, and then you've taken things forward. How did you manage to convince, or how did these companies take it? Was the responsibility from the board, or was it pushed from the bottom upwards? And then what were the results like? I mean, was it a result-oriented exercise, or was it a feel-good exercise?
No, it's much more than feel-good exercise, Yumi, in our case. And as I said, while we looked at the global standards, we also looked at global standard on governance. So whether, let's say, sustainability or a ESG as an issue is driven from the board or the senior most executive of the organization, and we looked at, yes, it is been driven by the board as well as committees and senior most organization. In our case, what we did 4 years back, we came up with a new committee. Earlier, there was a board level committee which was looking at only risk management. We integrated sustainability and ESG as part of that particular board level committee. So we have an independent director. We also have the executive directors as part of this committee, and this particular committee actually becomes a sounding board to our the full board of the organization. So all of, so let's say, the executive directors who are sitting on this committee, they have their compensation and performance linked to ESG. Predominantly within ESG, of course, it is climate safety and those kind of issues. But in our case, actually, it has been driven right from the top, Yumi.
Right, understood. So I'll just quickly circle back to Azam for a quick one, and then I'm going to come back to Jasmine on the funding part of it. Azam, just on the governance side of things and implementation, I mean, you've seen many companies in your seat, and maybe Manpreet can contribute to this as well. Are they really doing this for funding? Are they really doing it for a financial benefit, or are they really doing it because they really feel there's a long-term benefit to the environment or social impact? Either way, how does it work?
Obviously, different companies have different motivations, right? So, and sometimes you see certain industries, it's a customer-driven element. Sometimes it's regulator-driven. Sometimes it's a public perception-driven, and sometimes it's employees-driven as well. And what we find is that studies show the most critical element of a successful sustainability strategy in a company is leadership, and everything else comes secondary. Number one is leadership, and I heard Vishal mentioning that point. as well. When there's leadership commitment, when there's leadership understanding, everything else becomes easier. So where you find the businesses doing well, embedding sustainable practices into companies, leadership has really shown the way. And it needs to be a little bit of an enlightened self-interest, really, isn't it? So in the sense that, the boards need to look at longer-term value generation. We can't run quarter to quarter. If anything, the crisis, environmental, the inequality crisis or the health crisis has shown that a longer-term perspective is critical, even for businesses. And the businesses who have shown that longer-term perspective has been able to really be more resilient. So it's about at the board level looking at ESG, looking at sustainability as a longer-term perspective, and that's what's really going to embed that into the business strategy. And I like to see, I mean, you mentioned about risk, Vishal, it's great, and that you have a committee. I mean, you can look at ESG from a risk perspective, an opportunity perspective, and a trust or integrity perspective, where it all comes together. I mean, just recently I saw a multinational company which, does bottled water and, whole host of it. It says 100% trust twice over in a logo in the bottle. And it's trust is critical to the business model, and if anything, what is a business other than looking at opportunities and assessing risks? Over to you.
Manpreet, would you like to add to this?
Sure. I mean, let me give you another perspective. So what Azam said is the ideal perspective with some of the advanced organizations, but I think we come across different kinds of organizations all the time. So there are organizations where, the awareness levels at the top management level are pretty low. And therefore we see a lot of what they should ideally be doing on ESG goes towards creating some sort of a small department on sustainability where, most of what they do is ideally to ensure that there are enough amount of communications that they send, whereas, at times there is no actual work. Similarly, there are no, performance reviews on sustainability or ESG side. Even if you are talking to the CEO about, how a carbon footprint reduction is important, I think it's in absence of so many things that could act as drivers. At least in some of our geographies, it's still hard for companies to, understand why they need to reduce carbon, especially because there is no price on carbon today. So in one of the meetings that I had recently, I was trying to, emphasize on why it is going to be increasingly important for them to look at a net zero strategy. But then I think I couldn't, beyond a point, excite the CEO much because, beyond a point, I could not give, the value addition of what that would entail to the business in the next 2, 3, or 4 years. So I think there are companies definitely for whom there are opportunities, and the senior management is increasingly realizing that. But I think we still have a long way to go, I would say, in terms of actual senior management participation as well as representation in the decision making on ESG.
Right. Thanks, Manpreet. I think I've broken the norm of ladies first, and I think it's all going to be on Jasmine Ling now because we have a huge focus on finance, and there's a lot of pressure on you, Jasmine. We're waiting to hear from you. I left the best, I think, for the last, but I wouldn't say last. We have a few questions that are coming in as well. Jasmine, I know there's a lot that I want to ask you. I mean, I could have a full session on financing just with you. But can you just give us perspective as to what sort of finance? I mean, I'm going to give you a very broad question and just open yourself up to explaining this. What sort of financing options are out there? I mean, it's always a myth that there's only an investor that has to come in. Is that so? Are there other things? Number one. Then B, what is really important for investors or for the financiers, and what should you be as a company doing? Let's take this together. And then I've got a lot more to ask you. So if you've got more time to give us, I'll be more than happy to direct these questions to you.
Sure, no problem. So, Pumi, I think the question about what are the financing options out there? I think as sort of a context, I think the bank actually play a very important and critical role within the financial system. How we can actually channel the capital allocation from sort of the investors to actually the eligible projects that will actually drive change to sort of this sustainable agenda. So currently, if you look at sort of my background is more sort of on debt instruments, but if you can see in terms of the overall construct, I think Manfred highlighted briefly just now, like there are two key instruments in the market currently where companies sort of can leverage the instruments to go about sort of the sustainable narrative to investors. First is the use of proceeds instruments, where obviously the financial instruments would have a clear purpose and ring fence to certain eligible projects that can bring positive impact to the environment and or social. And a second stream of instrument would be sort of the KPI linked or the sustainability linked instruments, where there would be no restriction to the use of proceeds, so it can be applied to general corporate purpose funding, but then actually the pricing of certain structures of the instrument will be tied into the sustainability KPIs or commitments by the company, so that can be sort of reviewed on an annual basis, and depending on where the company can achieve those targets, then there will be adjustments sort of to the payout or the pricing of the instrument. So I would say, well, there are pros and cons to and merits to both instruments. Green bonds and loans, obviously it has been, and social bonds and loans, obviously it has been in the market for a longer period of time. And sustainability linked loan is more recently in the past 2 or 3 years, where we sort of have the APLMA and the ICMA define what is this sustainability linked instrument mean. So I think we see sort of a lot of maturity starting in the market. Just quote some stats, for example, in terms of the sustainability bond and loan markets, I think globally we do see a CAGR of over 60% year on year in the last 5 years. So that actually demonstrates a point about how investors now actually would have increasing focus on these type of instruments. And it is not only now that people would think, well, sustainability investment means I need to forego certain yield to achieve certain sustainable objectives, but where we see from the pricing of the instruments and the performance is that investors believe that it can be done in parallel. So for asset managers, for example, what we see is that the investors will actually ask for both yield and sustainability strategies when they invest. So I think, yeah, so I think for that's sort of the overall overview in terms of, for example, financing, what are the key instruments. But then obviously from investment side, we do have like green deposits, for example. Some of the banks have already developed this, is where companies can actually place these idle cash with banks, and then we will pair up this with eligible financing, so that the company can indirectly contribute to investing in their sustainable means that are actually aligning with their company strategy as well. So yeah, hopefully sort of that answers the first question as to what financing is available out there. And your second question is, I might have missed it. Can you sort of?
No. So what I was asking is, what is really important for these companies to do? I mean, what are they really looking at? And I mean, you'd say ESG initiatives are reducing cost of capital, but are there general themes that the investors are looking at, the financials are looking at? Because if that's a motivation to engage in this journey, be it. But what should they be focusing on, was what I asked second.
So I think, well, with the focus, we talked about how stakeholders, not just investors, right? We talk about UN, so the NGOs, how the governments are also regulators are focusing on sustainability considerations. So I would think financing would be sort of the means for the company to actually demonstrate or put up sort of their company narrative in sustainability. I think the importance, and as a bank, I think what we sort of need to acknowledge is that, well, companies are in different stages in the sustainability journey. So we sort of need to understand, given, I think for HSBC as well, we are an international bank. We cover like 17 sites in Asia Pacific, as well as we have sectors. We cover clients in different sectors and different sizes as well. So I think what we want to sort of help the companies is also understand the narrative in the sustainability journey, or whether or not we are talking about sort of a minimum requirements is a regulatory push where there would be environmental policies or social policies that come in that you actually need to sort of evaluate your business model, or it may be sort of the physical risk that you say, well, I think the impact of COVID already demonstrates how an abrupt physical situation can actually impact the resilience of your business operations. And for example, I mean, in terms of the corporation, so it's not just the investors or regulators asking sort of for the focus of the sustainability strategy of the company, but even the corporations itself, right? How the buyers are actually, because they start to need to either report these sustainability commitments, or because they're required by certain stock exchanges to report these sustainability stats, then they will actually need to also go to their suppliers chain under sort of along the supply chain to also encourage different companies to start and embark on these energy sustainability initiatives. So that will be actually how we see how the overall ecosystem will start to move towards focusing more on sustainability. And then I think what I will observe is that 5 years ago, companies in Asia can say that, oh, actually sustainability might be still a CSR channel for me. I can just put out a few like donation budget, and maybe that would already put a checkbox in terms of a CSR strategy. But as we see now, I mean, there are different stakeholders coming into the ecosystem. And there would be an urgent need for companies actually to understand where they stand in their business model and make sure that they are not being left out and caught off guard when sort of these minimum requirements come in. I can quote an example. Like previously, I had it with a client. So it's a listed company in Hong Kong, and she is actually the sustainability officer for the company for over 10 years. And she was joking. I mean, 5 years ago, every time she would actually print up the CSR reports to the annual or interim results announcement, actually they would just carry the full deck back to office after the event, because actually nobody really cared about ask questions about sustainability. And she was joking, like, now at least starting 2-3 years ago, obviously I think they would need to stop printing any reports, but then the feedback is that they actually now most of the questions from investors are not asking about financials, about sort of their like P&L. It's more about what the sustainability strategy is going forward, and actually they have a dedicated session for sustainability. So it's just an example of how, I mean, the ecosystem has evolved quite rapidly, and I think companies, not just companies, I mean banks, regulators, everybody just needs to be prepared in terms of what this entails, and start to sort of think about it as a forward-looking strategy. So yeah, so I mean that's sort of my observation that I see in terms of where we are.
That's great. I mean, I'd like to just maybe go around the panel and then see what their experiences have been as well. Vishal, I know you guys have practically gone and gotten financing, and what was your journey like? And I'll circle back to Azam, Arif, and Manpreet as well on this.
Yeah. So as I said, like we have we are a growing organization, and there's a lot of growth which we see in our business in next 10 years. Time and again, our teams are in need of, let's say, financing and funds. So last year, actually, around October is when we wanted to raise capital. We wanted to raise funds. So we did brainstorming with our finance team, and they were very keen to tap this potential of sustainable finance. We started exploring. We looked at what have, let's say, companies in our sector done in terms of sustainable finance. We found few companies who had taken that route of sustainability linked bonds. So we along with the finance team, we started working with a lead banker, and we take that route to raise sustainability linked bonds in our case. So in Jan or Feb 2021 is when we went to market, in lead up to going to the market and doing the investor roadshow, actually we had like 3 to 4 broad steps which we had to undergo. One was to be ready in terms of all documents for our bonds process. Second is, as part of this, you need to undergo a thorough due diligence process. One on legal due diligence process. So we had to sit through all of the legal teams from third party, where we had to address all the aspects of legal issues as well as environment and social issues. The third part was trying to be ready in terms of getting the second party opinion done. What Manpreet also said in his talk was that, as well as Jasmine mentioned, that the second option of raising finance, where you can raise that funds and use it for the share of proceeds could be used in any part of our business, but it is linked to one particular KPI. And we are a construction material company, and the single most material issue for us is carbon emission. So with the lead banker, we were able to narrow down on what KPI should be set. So it was the carbon intensity in our case, which we set as a KPI for this whole bonds process. And along with the second party opinion, we were able to conclude that it is an appropriate KPI. And finally, in the month of Feb is when we went to, we did the investor road shows, and we had gone to market, and our whole bond process was oversubscribed by 4 to 5 times. We were able to raise about $400 million as part of this. And as I said, the KPI which we have set is on carbon intensity. We set ourselves to reduce our intensity by 22.2% in 10-year period. And if we are not able to achieve, the point which Jasmine made is, of course, we'll have to return maybe 75 basis point higher to the investors or the bond subscribers. But the key driver, of course, maybe I'll also say that the driver for us to look at this route were two. One is to reach out and tap the international market. And second is also to give strong signal to market that an organization like us is committed to sustainability in ESG, and we are ready to put one particular KPI online, and also say that we have skin in the game in terms of we are ready to set ourselves an aggressive target, and we would want to achieve that target for that single most material issue for us.
Okay, thanks, Vishal. I mean, I'll just quickly segue this into 2 questions for Manpreet. Manpreet, how would an organization start this journey in, going towards financing? And then maybe you could sort of take that into the fact that there's a lot of data out there. Maybe the risk of greenwashing and all of that could impact this as well. So if you could just give us a little brief on that, that would be helpful.
Yeah, so I think as Vishal has already indicated, there are various options available, today for an organization to look at funding. I think what matters is what is the funding or financing going to be used for. Like in Vishal's case, the company wanted to very clearly set a KPI for reducing carbon intensity of their operations. I think that is a very specific sort of an initiative that an organization can look at taking as well. But when you look at large infrastructure investment coming in, for example, for funding solar or wind or renewable energy installations, or even looking at specific opportunities, for example, in waste management, or even climate change adaptation, or wastewater management, and so on and so forth. So I think there are a number of areas which are therefore eligible to get these green financing through various options. I think what really depends on is what are the ways in which the company looks at financing, because at large we haven't seen a lot of difference in terms of a green bond vis-a-vis a vanilla bond, in terms of the rates of financing. But what we are increasingly seeing is that there are different kinds of investors that one can access, and therefore going forward, as the demand increases for sustainable finance, we are definitely expecting that the investors will be able to offer much better and concessional financing rates going forward. So the way to start is to first of all conceptualize what is going to be invested into, and then look at various options that they have in the market and the instruments that are available to them which they can use. And they can obviously make a comparison between issuing a green bond vis-a-vis something like a sustainability or ESG linked bond, like Vishal alluded to, because each of these different instruments have their own benefits that you can see. Of course, the bond market, the green bond market in particular, has been increasing. I think Jasmine did allude to the fact on a very high CAGR when look at the increases in the bond issuances in the last few years. So let me not comment on that, but yes, increasingly the corporations are finding benefit in terms of using some of these green financing instruments. And I think the whole kitty is really growing in terms of the innovations that are happening in the sector. We are now looking at transition bonds, climate resilience bonds, catastrophe bonds, blue bonds, and so on and so forth. I think each one of them have their own benefits attached to them. So I think it's best to explore what sort of investment that you're trying to make, and then therefore what instruments would likely be available to you.
So I think there's a question that has come about on actually the independent verification of all this data that's coming around, and do all the claims by these companies have such an impartial investigation and confirmation? Arif, would you like to take that?
Yeah, I think one of the main challenges that we have is that the reporting on ESG is not really mainstream at the moment. It's really it hasn't been mandated by a lot of the countries in our jurisdiction. So, for example, in Sri Lanka, India, Bangladesh, Pakistan, there isn't a real mandatory requirement to report on ESG. Most of the ESG reporting is voluntary, and so companies are encouraged to do it. And therefore, when things are voluntary, the audit and the credibility of the information will always be in doubt, and therefore, the greenwashing element comes into it. So I think there's got to be a movement by the governments in our region to move ESG reporting into mainstream reporting, and capital markets also have to rise to that challenge. I think the capital markets here need to adopt sort of indices on evaluating companies on their ESG performance. So there has to be a mandatory reporting, there has to be mainstreaming, and at the end of the day, there has to be reward for companies for reporting as well. And the reward is obviously a share premium on your valuation, long-term patient capital coming in, that's rewarding companies who are reporting, and therefore it's a start of a long-term cycle. I think, from my point of view, qualified accountants, ACCA members, the big four like KPMG have recognized that we can no longer just provide the credibility around the financial metrics. A lot more credibility has to be provided on the qualitative reporting now and the non-financial reporting, simply because I think the speakers have indicated the interconnectivity between the financial value and the social value, the social capital, the natural capital, and the relationship capital, the human capital. They're all interrelated, and therefore we can't continue to focus on providing the audit of simply the financials. We have to widen the scope.
That's great. I mean, I think we all agree on this, and I see Azam like really nodding his head frantically. Azam and I think even I'd like to ask actually all of you. I mean, there's a lot of discussion around circularity and the concept of circularity. This is also getting into the how. How can companies engage in this? What are the benefits? And I mean, are we doing enough of it? Is that the future? Is that what we're looking at eventually? Can we shed some light on this?
I think we could end up, I think the jurisdictions here have to look carefully at that, because one of the impacts of a circular economy or a circular business is that you will be required to look at your raw materials, your finished products, and look at recycling them and bringing them back into your value chain. And I think there could be a poison sort of pill in that for the countries in South Asia, which rely heavily on textile exports, etc., exports that rely upon biodiversity and ecosystem services. So I think we have to manage this very, very carefully to see how it's going to be of benefit. Because don't forget, we do have a large large-scale poverty in the region, and we have to bring people out of poverty, which relies a lot on economic growth. So we can't abandon economic growth. There has to be a balance. I'm sure Azam, can say a lot more about that.
And you're right. Azam, would you like to add?
I mean, we can talk all day, so and I think it's critical that we look at the local context, and Arif really hit the point on the nail there, in the sense that we need to look at the local context and see what are the sustainable challenges that are facing at the moment, and what's the best interventions that could be made. Arif mentioned about mandated reporting. I think that's really required, and we've seen globally the number of exchanges covered by mandatory rules on ESG disclosure more than doubled in the past 5 years, currently at 25, an UNTAG report was saying. But we don't see that yet in the region, so to say. But making those incentives and making those incentives to the businesses to sort of mainstream its reporting into this as well will create a catalyst for the change. We need to make those important exchanges. One point, and since we have seemingly a lot of finance professionals around here, is that what I see in my experience in the private sector is that when the CFO gets interested, things gets moving. So what we're seeing is that when the CFO, Vishal, you're smiling, I can see that, is that when the CFO is interested in sustainability reporting, making sure it's included in annual report, then we get more focus, we get more resources, and when CFOs understand, and there is financing opportunity with this, and they're as excited as well. This is real. This is not something extra outside the business model. This is the business model. This is part of how businesses need to be moving. And there's, for me, in a simple way, the fact that the CFOs are getting involved and taking responsibility in some companies. And I take Manpreet's point. In many places we don't see this, but I think movement is there, but there is a lot more that needs to be done, and I think we need to regulatory wise well make some of those interventions to help.
Okay, I've just got one question for Jasmine, and then I've got one more for Manpreet. Manpreet, if you could hold on, and Jasmine, I know you both need to leave. Jasmine, we're looking at traditionally banks in our region still looking at security-based lending. How can they change their mindset? What should they be looking at? I know you're very involved in this with the HSBC agenda, so maybe you could shed some light on it.
Sorry, I'm on mute. Yeah. So yeah, I think it's definitely how within the bank, how we continue to sort of align our climate or sustainability strategy with also sort of our risk teams to understand where we are sort of in the ultimate capital allocation strategy. Honestly, definitely this would be a journey for us in terms of how we would also balance, the risk reward and make sure that we are comfortable given, I think as a bank, as a minimum, I think this will continue to be sort of last defense, last line of defense for us. Sorry, I have so last lines of defense for us as well. But I think what we actually now will work together more is, in terms of building a sustainability franchise across all sectors, how we actually start to need to assess, our credit appetite as well, not just, on traditional high transition risk sectors, but obviously new technologies, new sectors, not just in the renewable space, but in terms of, we talked about circular economy, we talked about e-batteries, we talk about new hydrogen, blue hydrogen or green hydrogen technologies that are coming in the way. How can we actually also build ourselves as a bank the knowledge of these different industries and sectors, and then help different companies to transition as they invest more in different R&D, as well as also helping. I think the point about the point that Arif made as well is we need to sort of recognize as well. I mean, in Asia, there are a lot of developing markets as well. I mean, although there's sort of like a global sustainable taxonomy or agenda that we need to move towards, we also still need to support the livelihood of emerging economies, and how we can sort of strike a balance in terms of transitioning our economy as well. So, I mean, definitely this is something, I mean, as a bank, we have committed to be a net zero bank by 2050. So obviously there's a lot more to be done for us as well to move towards and helps support our clients in this journey. Yeah.
Great. I'm conscious that we've come over time. So I'm just going to ask for a quick round of closing remarks from everyone. I know you've all got very strong opinions and a lot to take to the table, and we could go on for days with such a great panel on board. Shall I start with Manpreet and then we can go around?
Thanks, Vivi. I think very interesting discussion. I think as Arif told in the beginning, it's a very vast topic, it's a very broad discussion that we've had today as well, touching various issues. I think for the benefit of the financial institutions who are probably highly represented today, I think it does make sense for you to have a look at your portfolios. Increasingly, so we're seeing, that the risk that's going to come to you as financial institutions are largely going to come from the investments that you make. So it definitely makes more sense to, one, understand the carbon intensiveness of your portfolios, as well as also understand how different kinds of climate risks are going to impact you, which could probably become a huge risk going forward in the future. I'll end at that, Vivi. Over to you.
Thank you. Arif?
Yeah, I think my advice to the audience and stakeholders is, do things simple, keep them achievable. Look at your business model, look at your product life cycle assessment, look at the footprints you're generating. Try and work a little bit on materiality. What do you need to communicate to external stakeholders? So materiality, we haven't talked about it, but it's very important. KPIs, I think, try and develop a set of KPIs across the workforce to achieve ESG targets. Reward people within the organization, reward teams for achieving ESG targets. So I think keep it simple, keep it achievable, keep it measurable.
Thank you. Jasmine?
Yeah, definitely. I'm very happy to be involved in the panel today. I think from sort of the audience and the spectrum of audience that we see today, I think a lot of us are very interested in this topic, and it is exactly the kind of panel like today that we can actually facilitate more discussion across all stakeholders. So across, corporations, regulators, NGOs, and banks, so that we can sort of strive the common goal. I think it's rightly pointed out that there are different sustainability standards and also taxonomies around the world, but how can actually we strive to come to a common ground where we can actually facilitate the discussion cross-border and make sure that we can actually come up with a plan that works for all stakeholders here. I think it's definitely a long journey. We need to work step by step, but I think it's definitely a good starting point that we are actually talking across our stakeholders here. In fact,
I'm going to go with Vishal and then come to Azam.
Yeah, I think interesting perspective which we got from all the panelists. I would want to close by just giving 2 points. One is, as a practitioner, maybe there will be a lot of clutter, there will be a lot of noise, lot of expectation which will be thrown at you. What you need to do is, which organization or which sector you are in, try to look at the material issue or material area for you, and then focus on that area. That is one. And second one is like sustainability or ESG again is a long drawn process, and it is more of change management or culture building. So try to focus on that area also. We didn't speak much on culture, but it is very important for organization to look at the culture you involve your employees and stakeholders who can be part of the journey, and we also focused on that aspect as well. So that is what I would want to close at, Pimi.
Great. I mean, that's a very important point. Unfortunately, we ran out of time today, and I think that's a question I had lined up for you as well. But thank you for that, Vishal. Azam?
Thanks, Pumi. Thanks, colleagues. I think just a couple of points. One is for the companies to look at the internal alignment as well as the external alignment. We spoke a lot about the internal alignment with the materiality, looking at the priorities, disclosure, and so on. Or with the external alignment, making sure that we are able to the creation of a portfolio of partnerships that can aid the company to progress. The partnerships could be with a range of stakeholders, because there are expertise that people bring in from different aspects of society that the company may not have. ESG is an area which is not natural for companies to be really have expertise on. So this partnerships is critical as well to really progress forward. That's one point I'd leave behind.
That's great. Thank you, everyone. I mean, it is a journey that we've set ourselves to go forward, and yes, we need to walk together in it. It's a long journey, and hopefully steps like what ACC has taken today will contribute to it. And all we can hope for is that our children are going to look back and say, you guys did a good job, right? So with that thought, I'd like to thank all the attendees and the panelists, and let's make our children proud, right? Thanks, guys. Thank you, everyone.
Thank you, everyone.
Thank you.
Thank you. Bye-bye.
Bye.